Hey everyone, welcome to Simplified Finance. As you guys know, knowledge is power, especially when it comes to your money. And with the UK's new financial year starting April 6th, 2025, there are some big changes you need to be aware of. Whether you're an individual taxpayer, business owner, or investor, these updates could significantly impact your finances. But don't worry, that's why I'm here. We'll break down exactly what's new, from national insurance contributions to capital gains tax and dividend allowances, and most importantly, what steps you can take to navigate these changes effectively. So grab your notebooks, get ready to take some notes, and let's dive in. First up, let's talk about national insurance contributions, or NICs. For employees, the good news is that the Class 1 NIC rate has decreased from 10% to 8%. That means a slightly bigger paycheck for you. However, for the self-employed, the Class 4 NIC rate has been reduced to 6%, and Class 2 contributions have been abolished. Now, for all you employers out there, the NIC rate has increased from 13.8% to 15%, and the threshold has been lowered from £9,100 to £5,000. This means higher employment costs, especially for industries like hospitality and retail. It's crucial to factor these changes into your budgets and consider potential adjustments to your business strategies. These changes directly impact your take-home pay and business expenses, so make sure you're prepared. Alright, moving on to capital gains tax, or CGT. This is the tax you pay on the profit you make when you sell something like a property or shares. If you're a basic rate taxpayer, CGT has increased from 10% to 18%. And for higher rate taxpayers, it's gone up from 20% to 24%. From April 2025, the CGT rate on carried interest has increased to a flat 32%, up from 28%. And here's the kicker. There are plans to tax it fully as income from April 2026. It's essential to understand how these CGT adjustments affect your investment strategy. Make sure to factor in these increased rates when calculating potential profits from your investments. Next up, we're talking about dividends. The dividend allowance has been cut in half, from £1,000 to £500. This means that any dividend income you receive over that £500 threshold will be taxed. One thing you can do is consider investing in stocks within tax-efficient accounts like ISAs. This way, your dividend income can grow tax-free. Remember, this change highlights the importance of diversifying your investment portfolio. Explore other investment options and strategies to ensure you're maximizing your returns while minimizing your tax liability. Alright, so we've covered a lot of ground, and you might be wondering, what can I actually do about all these changes? Well, I'm here to give you an action plan. First and foremost, utilize tax-efficient accounts like ISAs and pensions. The annual ISA allowance remains at £20,000. Giving you a fantastic opportunity to shield a significant portion of your investments from taxes. If you haven't maxed out your ISA contributions, now is the time to do it. Next up, consider offsetting any capital gains you've made by selling underperforming assets. This strategy, called tax loss harvesting, can help reduce your overall CGT liability. Another smart move is to consider transferring assets to your spouse or civil partner. Now, given the increased CGT rates, timing the sale of your assets is more critical than ever. Instead of selling everything at once, consider spreading your disposals over multiple tax years. This way, you can utilize your annual exemptions effectively and potentially reduce your overall tax bill. And finally, don't be afraid to seek professional advice. Tax laws can be complex and are subject to change, so consulting with a qualified tax professional can provide you with personalized strategies tailored to your specific financial situation. They can help you navigate these changes effectively and ensure you're making the most of your investments. So make sure to do your research, seek professional advice when needed, and stay ahead of the game. Okay, guys, we've covered a lot of ground today. The UK's 2025 financial year brought some significant changes. We talked about national insurance contributions, capital gains tax, dividend allowances, and what you can do to adapt. Remember, the key takeaway here is that you need to be proactive. As always, thanks for watching, and I'll catch you in the next one.